Okay, and I think we're live. I think people are just entering the webinar, and I'd like to say welcome everyone to ARCO's next event as part of our digital season. And as you will probably know, this replaces our annual conference that we normally run in July, but we've taken our event series digital, and this is the third event in our digital season on tenure and regulation. And we, if we're honest, we didn't actually think we'd have that many people interested in this as a seminar, but we had about 230 people sign up, which we're very pleased about, because I think that issue of tenure and wider regulation in our sector is very pertinent and is going to be one of the key things, I think, to discuss going forward. We've got a cracking panel of speakers joining us from, including from New Zealand, from the UK, and especially with our partners, Trowers, Gowling, Eversheds, CMS, and Pinson Masons. They're going to form a legal panel to talk a bit about what the background is, the current situation on event fees, and then we'll hear from Peter Youngs from Knight Frank as well later. So thank you very much to our partners. I'm also joined today by my colleague Sally Ireland, and Sally Ireland started with ARCO in January because what we did is we did a skills audit at ARCO, and we found that we didn't have many people who were used to working in 6-minute increments. And we thought that was a bit of a skills gap there, so we recruited Sally. So kind of joke aside, Sally is a trained lawyer, trained barrister in fact, and is our new head of regulation and compliance. And the reason why Sally started with us is that a lot of ARCO's work is quite technical, is quite focused on regulation and legislation, and Sally's new job is effectively, one day to write a retirement communities act for the UK. We've had a very interesting time, Sally, I'd say, in terms of the coronavirus. And, Sally wrote parts of the coronavirus easement bill, and we were working with the Department of Health on that one. So that was quite an interesting time we're having, Sally, I'd say.
Yeah, absolutely. Mm.
So just in terms of some housekeeping, we are going to do Q&A via the Q&A function on here. So if you have any questions, we have colleagues behind these tiles down here that are looking at those, that will try and answer them. And then also they will come up and we'll put them to our panelists. And hopefully they will be answered that way. Now, to looking at the topic at hand, I think when you talk about new tenure models, what always surprises me is that a lot of the conversations, when you mention new tenure model, people actually think what you're talking about is rentals or maybe shared ownership. And I'll have to admit that until a few years ago, I was probably in that same camp, when actually what we're talking about is a different contract that would govern the relationship between the resident and the operator, and is more likely to replace the leasehold model, which certainly the for sale market in the UK currently operates under. So that's really the kind of bit that has been a really hot topic of discussion. We first discussed this at our board probably about 3 or 4 years ago, and we've recently actually started stepping that up quite considerably. So to start us off, and we'll have some speakers who are going to come in on this, but to start us off, I was going to talk a bit about looking at this from a customer perspective, not from a legal perspective. And what I was going to do is think a bit about what do customers actually want when they move into a retirement community, and if they're purchasing a retirement community, because that's really the main focus of today. So if we could have our first slide, because what we started with is really kind of some thinking around what are customers really looking for. And we've obviously they look for different things, and no customers, no two customers are the same. But if we look at the first column of that table, if we could have that please as a slide, we think there's a number of issues that customers are after. And one is they probably want they want options that suit their financial needs, or some flexibility in terms of how they buy or occupy their unit. They want services to be guaranteed. They want that safety net to be there. Cost certainty is something that research shows is incredibly important to older people who are asset rich but income nervous, which is how someone put it, which I thought was very interesting. a lot of them also worry about what happens when I have to leave, what happens when I die. And I think there's that hassle-free resale for the families, because there's stories that these things, may not resell, which is not really something we've experienced in the retirement, or sorry, in the housing with care sector. But traditionally there might have been some issues there, but that's certainly worry. And then there's a consumer protection in terms of, you want to know that your rights are guaranteed. And the interesting thing that if we then look at the leasehold model that currently is in use, I think leasehold is very well established, but what it offers is probably not quite what consumers are after. So if you look at the traditional leasehold system, rather than having flexible options at every purchase, the lease terms are actually set for 125 plus years, could be 250, could be 999. Which at an extreme would mean that in 80 years' time, when the 15th person occupies that particular property, they would still do so on the terms initially agreed between the first purchaser and the initial vendor of the property. So you don't really have any flexibility to change those terms to the incoming resident, especially on resales. Now, in the traditional leasehold system, the issue about guaranteed services is also not quite as clear cut, because obviously what you have is that the majority of leaseholders can vary services if they're not specified very clearly in the lease. And there have been instances where some residents, normally residents who are more able-bodied, may want to reduce the service delivery or, like, for example, 24-hour staffing, and reduce that down to save money, when other people are saying, look, these are the services why I came here in the first place. But under the traditional leasehold system, and we'll talk a bit about alternatives in a minute, that is actually possible. Cost certainty is another one. Leaseholders are liable for all the costs that are incurred, and there's quite tight legislation around that, which is quite good. But obviously major repairs are also responsibility of the leaseholders, including looking after not just their units, but obviously also the communal areas. So if the clubhouse or something else might need replaced, that is also something that in the traditional leasehold system would be the responsibility of the leaseholder. Then you have the resale issue, and in the UK, obviously with probate being granted, flats can't be sold until that has happened, and that's normally at least, well, on average about 9 months, 8 to 9 months in the UK, during which service charges usually remain payable, and then the family also has to take care of that and would normally be asked to refurbish the flats, although we have members who are now changing all of this, which we'll come to in a minute. And then we have issues around consumer protection, where other countries have sector-specific legislation, but our members are effectively working around the Landlord and Tenant Act, which is not specific to our sector. So that's really what the leasehold sector does. And in my view, there's quite a few things that the leasehold sector does well. But I don't know what Sally's view is, but what would you make of these arrangements as a lawyer, I guess?
Yeah, I mean, leasehold is obviously, a well-known model of tenure in the UK, and it's very well established. And one of the advantages of that is it has legal certainty. Conveyancers are used to looking at leases. People generally know what they mean, and there are lots of protections written in for leaseholders in relation to freeholders. For example, on service charges and reasonableness, there's a whole statutory framework there. But obviously they were never designed for retirement communities in particular. And one of the things that struck me coming into this sector is how really very different the proposition is for a consumer coming into a retirement community or extra care housing compared to an ordinary property transaction. Because really what you are buying is, it's not just a flat or a house, it's obviously, a really long-term arrangement whereby you'll be provided with a high level of service provision, hopefully throughout the rest of your life. And you'll have a close and ongoing relationship with the operator. And that's not really what your standard leaseholder freeholder relationship looks like. And one of the other things is that there's been a leasehold reform agenda more broadly in the last 10 years because of problems elsewhere in the leasehold system. So the typical example is a block of flats with an absentee freeholder, unreasonable service charges, people can't really contact their freeholder if they have a problem. They might have a managing agent in place who's not helpful. You know, problems with ground rents, and you know, there's been lots of controversy, and this has driven policy and politicians to look at alternatives such as common hold, which, you know, might work very well for your ordinary block of flats, but in the retirement community sector, you really need the operator there, because the operator is going to be the one who has the long-term interest in maintaining the community and providing the services. It'd be really, really impossible for leaseholders to step up and do that themselves. So we, you know, if leasehold disappears for you know, the other types of property, we might need something different for retirement communities.
Yeah, and I think we've had lots of conversations about why this was, and I think we always come back to this point of, well, we can make it work for now, but if we started afresh, you probably wouldn't start with leasehold, I guess. And I think it's an interesting conversation that the wider sector's had. And then we basically, if you look at the how you would respond to customer demands, so if we could have the next column on that there, please, Katie. If we look at what an alternative model could look like, that would maybe respond better to what customers want. I think the interesting thing there is that, you know, that flexibility that maybe customers could choose higher, lower upfront charges or ongoing charges in return for maybe higher event fees or lower event fees. And that would really suit their financial circumstances. That would be something which would be quite useful. And we've had incidences where, you know, we've had residents coming to some of our members saying, well, on a resale, saying, I would like to pay lower service charges and a higher event fee. But the problem was that the lease that was being resold by a family specified that there was only one particular deal on offer. So there's flexibility would be useful for the operator to change and vary those terms. We've already seen members guarantee some of, or, you know, take on the risk of providing services, including the cost of those. So the guaranteed services is something that many of our members now provide, that they can't be varied by a majority of leaseholders taking them back, but actually they're guaranteed by the operator. The risk there really is transferred then over to the operator, and that's the same with the fixed cost, and that's a very popular model. So we've seen people really the model of higher event fees and lower charges that are fixed, where the operator is then responsible for that, and they might even be fixed for life, is very, very popular when put to consumers. And then you've got the hassle-free resale for families. I mean, like the probate system in the UK really is an issue here, but we'll talk a bit about Richard Davis in a moment. But if you have a different relationship, then actually you can reoccupy the unit much quicker, which actually means that families pay service charge for shorter periods of time or not at all. And again, that's something whereby the responsibility for refurbishments would lie with the operator, not with the residents, making that much more of a hassle-free transaction. And finally, consumer protection, you know, having clearly spelt out rights and responsibilities is what alternative systems could offer and should offer, I suppose. And I think that's really the focus of our work in terms of what could they look like. So, and then I guess a question for Sally. I've mentioned that some of our members already do some of these things as far as possible. To what extent could the existing leasehold system offer some of these alternatives which would be responding to customer choices?
Yeah, I mean, we've seen a lot of innovation from ARCO members to respond to consumer demand in this area, particularly in areas like transfer of risk, controlling costs for residents, so particularly those regular costs that they will pay, instead of having a variable service charge, for example, having a fixed regular charge that's entirely predictable for the residents. Also then using deferred fees to control costs in other areas, and we're going to go on and talk about that in the second part of the event. But it is sort of adapting, trying to make the best of the leasehold system rather than starting from a new proposition of what would you design if you were starting again. And obviously there are some things which are more difficult in the leasehold system, like what you've mentioned about the flexibility. If you if you buy a resale property, you're buying it from the existing resident or their family, you're not buying it from the operator. And so, you know, it's very difficult in those circumstances to vary the terms. there's also the fact that, you know, we're getting reforms coming through, you know, for example, on enfranchisement, on right to manage, which are again designed for other areas of leasehold property, but which can affect the retirement sector. And so, you know, that they're creating kind of grey areas for the sector.
I think that's one of the things we did. That there's the ban on leasehold houses, of course, that I think is entirely justified, by the way, if you're building just family homes. We basically made representations to the Ministry of Housing saying in a retirement community or in a retirement village, a leasehold house just might be on a leasehold basis because it's tied into that wider system of service delivery, which a freehold relationship wouldn't work. So it's just one of those issues, isn't it? But what could an alternative look like? How will an alternative be structured, Sally?
Well, I mean, it would be structured, and we're going to hear from Richard Davis shortly, and you know, he'll tell us about what's happened in New Zealand. But really, the alternative is a contractual form of tenure. So instead of freehold or leasehold, what we're talking about is something like a contractual right to occupy property. This is something which, you know, is already happening in other jurisdictions like New Zealand. If we can just pull up the slide actually for the international comparisons. Let's wait for that. Got the next slide, Katie?
I'm sure it'll come up. Just
come up. While it's coming out, I'll carry on talking. So yeah, here it comes. So yep, here we've got the legal framework in New Zealand, and then we have state arrangements in Australia and in the US. They all differ slightly, but what they all have in common is that they are based on a contractual form of tenure, where you have a right to occupy, which is basically personal to the particular occupier. It's designed for the sort of length of tenure that you're looking at in a retirement community, rather than for 125 or 999 years. And it's also much more flexible because it's designed for the individual resident. And you know, it sets out all the rights and liabilities. And what's common to all those countries, even though their systems are slightly different, is that they have very standardized contracts, standardized disclosure documents. Obviously, in the UK, we at ARCO have our consumer code, which mandates a high level of disclosure and transparency for consumers, which is really important. And we also have consumer rights legislation, but there it's specific to the sector. So you'll have a standard pack that will go to the consumer. And so people will be much more familiar with these forms of tenure, and you know, it will be set out clearly, you know, what their rights are, what will happen at the end of their occupation, what fees they'll have to pay throughout.
So you've basically just admitted to the fact that this is not our brilliant idea, but we're shamelessly copying what other countries are doing. Is that what you're saying?
Basically.
Okay, I think that's interesting because, again, I think that's the point we're trying to make. This is not some utopian idea. It's actually something that we're behind the curve on this, and this is really where some of our thinking started. And we'd like to invite two more people to join our discussion, and that is Richard Davis and Sunena Stonham. So if you could put your cameras back on, and I'll introduce Richard Davis first, and I'll say good evening, Richard. Because I think it's probably, is it like 9:30 at night in your
approximately, yeah. Good evening, everyone.
So Richard is joining us from Auckland, and I think many of you will remember Richard, who was ARCO's chair for about 3 years, probably about 2.5, 3 years ago now, and he was the chief executive of Life Care Residences. And you know, Richard, we did a lot of work on the Law Commission back in the day, so really pleased to see you. And also the first time I see a drum kit in the background, like, you know, very popular.
If you get bored with my story, I'll play a few rounds for you.
Brilliant. And then Sunena Stonham, who is the head of legal at Life Care Residences and another lawyer, and I think Sally will ask Sunena some questions. But what I really wanted to do is that Richard is now the chief executive of Arena Living in New Zealand, with, I think you said, around 1,000 retirement village residents spread out in a number of schemes. And Richard actually introduced me to this concept of, you know, could there be an alternative? Could there be a license to occupy many years ago? And it took me a while to get my head around it. But obviously, the interesting thing is, Richard, that in New Zealand, no one's buying leases, no one's buying ownership. And one of the key things really is that in this model, people don't own the bricks and mortar, but they have this very secure tenure. So if you could maybe start with just tell us a bit about what you're doing now at Arena, and then what is it that you're actually selling the customer in terms of the contract or the tenure they're getting?
Yeah. Firstly, nice to be with you all, but I'd rather be with you all than over here. But anyway, that's another long story. So Arena, yeah, we've got 6 villages based around Auckland and the Bay of Plenty. We've got about 1,000 units and 1,300 residents. It's been a business that's been owned by multiple owners. We're owned by Blackstone, which is US based. Their model in New Zealand hasn't changed for a long time, as we've discussed, Michael. So very, very early on in the industry, the pioneers did start with a leasehold interest and very soon realised that that wasn't going to work in New Zealand. Didn't have the flexibility, and secondly, leasehold is almost a dirty word in New Zealand relative to the acceptance of it in the UK. A lot of bad experiences with people owning private properties that are leasehold, with ground rents being exorbitant, etc. So early on, they decided that wasn't going to work. They went to what they called a license to occupy. This is well before the Retirement Villages Act. There were multiple versions of that as the industry developed. Along came the Retirement Villages Act in 2003, which just brought some formality to the structure. So a resident buying into a New Zealand retirement village unit, they've got the security of the Retirement Villages Act to start with. They've got the code of rights, they've got the code of practice. Operators are required to prepare and hand a disclosure statement, which gives full disclosure of the terms of the contract. The actual contract is what we call an occupation rights agreement. In your language, it's probably known as a license to occupy, and I think you use them for some care facility beds. There's the key to the security for the resident when they don't own a leasehold interest or a freehold interest is that there's a statutory supervisor that sits in the middle. And a statutory supervisor is what we call it's a corporate trustee. So it's very similar to a personal trustee, except it's on a corporate level. So they have a statutory right to act in the middle. They actually have first security, a first mortgage over the retirement village. So no one can do anything without them giving their okay. It gives them a lot of control over the operator's balance sheet and financial security for the resident. The other thing that comes with the occupation right agreement is certainty for the resident. So they've got certainty of tenure as long as they play by the rules. They get fixed weekly fees. The weekly fees by the Act stop after 12 months. Most operators like us stop them on the date of vacation, so no weekly fees payable from when they vacate. The weekly fee is fixed when they come in, so never goes up. We are obliged to provide certain services that if they're disclosed, we are obliged to carry on providing those forever, unless we get a majority of the residents to consent to that. They don't have any worry about looking after the outside of the property. That's all the responsibility of the operator. So it's a lot of peace of mind. They move in, they know what they're getting, they get what they've been promised, and if they don't, then there's the Act and the statutory supervisor to call us to account. The other thing with our model, it's really simple. They purchase the unit, and when they leave, they'll get generally back 70% of what they paid for it. That's the deferred fee that is deducted. It ranges from 20% to 30%. It sounds like a lot, but the operator has to provide all of that external maintenance, long-term maintenance, grounds maintenance, etc. for the village. The other certainty they get is that generally most contracts provide for no loss to the resident. So they will always get back 70% regardless of what the operator sells it for. You mentioned probate before. No hold up with probate because the unit is immediately refurbished and resold. And if there's no probate, then those funds are just held by the corporate trustee or the statutory supervisor until probate is granted. So, I mean, there's a lot in there for the resident. There are rights for the operator as well, of course. So if residents aren't playing by the rules, are disturbing the enjoyment of the other residents, there are rights for the operator to deal with that. But on the whole, the reason why residents are buying into this model with a perceived lack of security compared to a lease is it gives them transparency and certainty and comfort that what they're buying into they get, and a really simple model to follow, particularly the fixed fees and particularly fees stopping when they vacate. So it's in our interest to look after the village. They don't pay for refurbishment. I mean, it's a really simple contract and well received.
Right. Okay. Two things there, and just for the people listening to this or watching this, if you have questions for Richard, just drop them into the Q&A, and we'll put them to Richard and Sunena together after the session. I'd like to dig into two different bits. One is really the what you said around the residents, getting into that, and then the other question around, well, hang on a minute, if you're introducing this additional level of charge, or like first charge, what do the investors and the banks say? Because this could be perceived as being less secure. But if we start again with the residents, so one of the things that I often find here in the UK, when you mention we're looking at this different contractual model, is that some people say, and that's, particularly people who sell these to customers on the front line, so kind of I'm really interested in their opinion, but often they say people want ownership and they want to own the bricks and mortar, and they'll never go for this. So I don't know, what would you say to them?
I believe that the rate of home ownership in New Zealand is the same, if not more, than the UK. So we are big homeowners. We all own our own homes generally, particularly the target market. So the over 65s own their own homes. So that's the first thing. So we are homeowners, and we understand that you don't have to own the bricks and mortar to have the rights to enjoy a property within a retirement village. So no concerns from our market about that. But of course, this has been around for 30 years plus in New Zealand, so it's understood. But it's just getting your head around, this is a different way to own a property. For all intents and purposes, you own that property. You have rights over that property just as you would with a leasehold interest. And more so because of the statutory supervisor that sits in the middle. The question around the first mortgage, obviously there's no amount for that mortgage. It simply gives them the right to control the title to that property, so the operator can't go off and do something else, can't carve off land, they can't, it's a total peace of mind for one and for all in the village. And banks here lend all day, every day on retirement villages, knowing that they're sitting behind the statutory supervisor. Investors invest in the business because actually the statutory supervisor gives everyone certainty and comfort around how the village operates.
And that was one of the questions I had, in terms of, if you have that supervisor, you could, I'd initially imagine that might be difficult for investors because they say there's someone else meddling in the business, but you're saying it gives them comfort that the village will be well run. So kind of what's the trade-off between? So
they don't, the first thing is they don't meddle. As long as you run the village in accordance with the disclosure statement, you meet the regulations, the occupation rights, the code of conduct, then all they do is attend an annual meeting. They run the annual meeting. They look at your balance sheet to make sure that you are sound on behalf of the residents, and go away. They'll deal with any minor complaints as an independent body, but really no interference for the operator, as long as the operator is running the village appropriately and in accordance with the disclosure that they've made to the incoming residents. Mm-hmm. In fact, it's easier in a way because we don't necessarily have to deal direct with the residents or their advisors. Sometimes when someone's being particularly difficult, someone sitting in the middle can arbitrate, if you like.
And then just coming back to the probate point you mentioned, how long does it typically take between someone vacating the unit and the unit being sold? Again, in the UK, you probably have a 9-month delay on average until just probate's been granted, but then you need to obviously put it on the market and sell. Yeah,
no, it's definitely not that long. Because our model under the Act, and even prior to that, generally for most operators, the operator pays for the refurbishment. Naturally, we get all the capital gain, so that's a reasonable proposition. And bear in mind that if the unit's been occupied for 5, 10, 15 years, it needs a complete upgrade. So in New Zealand dollars, it's not uncommon for us to spend 150,000 Kiwi on a property we will sell for $1 million. So it's a full upgrade. So everyone, regardless of age of the unit, is moving into a brand new unit every time, which obviously helps with the sale. So as soon as we get the keys back, and the fees then stop for the outgoing, we get into the refurbishment. That will take us, because of the scale of it, 8 to 10 weeks. But we start selling it from the get-go. And we've had them as quick as soon as the tradesmen are out the door, the new residents moving in. But generally, on average, it would probably be 2 to 3 months from vacating to new resident moving in. So very short time, but that cost is on us. You know, we're paying a weekly fee. We don't get our deferred fee starting until the resident moves in. We don't get our capital gain until the resident moves in. So there's a lot of motivation for us to get that resold quickly.
And I think this really kind of drives at that point around, it's not really the amount of the event fee, but the value for money you get in return. And it sounds as if I get, you know, weekly fees that are fixed. And I think, can you talk a bit about the premium pricing? Because my understanding is that there's less of a premium pricing attached to the upfront price than there would be typically in the UK.
You know, Michael, though, that I've never been a believer in this premium pricing that that we talked about in the UK. I don't think it's actually real. Maybe it is first time round. It's certainly, I think, I'm not saying that everyone's operating like McCarthy and Stone, but their premium pricing is 20%, 30% less when that first resident moves out. I think we sell at very similar meter rates than a residential property in the market would sell. So it's like for like. In simple terms, we don't generate a premium. I don't believe operators in the UK are really generating a premium. And on the second time round, there's no big incentive for them anyway, because there's no major upside in them getting a premium. Whereas for us, every time it resells, we can benchmark back to the market.
I think it's interesting, and I think that the market here is shifting there. I think we are seeing different models, and like, you know, since you left, Richard, I think, you know, McCarthy and Stone's really turning itself into an operational business now as well, which obviously we're very pleased to hear. So that's all very welcome. And then just the final point again about the kind of fundability of this from an investor point of view, in terms of, you talked about the kind of the residents understand it, so that the people know what they're buying, and there's no real resistance because it's kind of done. That the family solicitors, they advise, and I think, how long did it take for kind of them to get their head around that, you know, you're not buying lease, which I understand, you're buying something else?
I think I said to you the other day that when the pioneers first started the license to occupy, they would get 20-page letters from the purchaser's solicitor querying how everything works, and now you don't get a single question. It's well understood. Solicitors are dealing with multiple purchases because they have penetration. And so it's very well understood. Early days, it was a challenge, and we needed to get around and talk to the Law Society, etc., just to get them to understand. But now it's very, very straightforward. All the information is given to them before they need to ask any questions with the disclosure statement. As far as the viability from a funding and investing perspective, again, that is very, very standard. So the developments are funded just like a new residential development, and probably even more so than a normal residential development. As an operator with a mature asset, CBRE, etc., Knight Frank will come and value the property based on a discounted cash flow. Operators can generally borrow 30 to 50% of that value as long-term debt. So very well understood by funders, even though they're sitting in behind the first mortgage of the statutory supervisor. So it's a very appealing market. You know, we've got 6 listed operators. One of them, Ryman, are the largest by capitalisation in the New Zealand share market. So it's a well understood investment vehicle.
We have lots of questions popping up in the Q&A as well, Richard. So we'll come back to you. We'll put those to you from our audience members.
Sure.
But thank you very much. And I think you know, we're you know, I guess the find and replace New Zealand with UK for our kind of work here in the UK is like, you know, that's one option, but Sally will testify that it's actually unfortunately a lot more complicated than that. But it's really interesting to hear that those models do exist and that they're really well understood. Coming really to Sanena now, and Sanena with Life Care Residences, and I know you obviously are a New Zealand business coming from there, and you know, Richard was with you until about three or something years ago, but you still obviously have those New Zealand roots with the owners. And maybe, yeah, some reasons why you've decided to look into this, because I know, you know, the likes of Inspired and all sorts of other members are now looking very seriously at these new tenure models, which we're obviously very pleased to hear. But what were your motivations, and what do you see as the main benefits of that potential switch?
So I do have a slide actually that might be quite helpful, and I think for us really the starting point has to be that the leasehold system does work for the sector, as otherwise we wouldn't all be operating using it, but that doesn't mean that it doesn't come with its challenges and limitations, and obviously being owned by a company in New Zealand, we have the insight and experience of that jurisdiction on our board. I think, Michael, you touched on some of the challenges that there are with the traditional leasehold model. And for me, there are probably three key challenges, which has made us look at what alternative tenures there are out there. Firstly, they are long-term leases. Our leases, for example, are demised to the original tenant for a term of 150 years. So each lease is essentially reassigned on the same terms every time a tenant or their estate sells the property. And as you said, this creates considerable inflexibility in resetting the terms of the original lease. But we've overcome this by developing documents which are collateral to the lease and only apply to the incoming resident until they dispose of the property. And that's enabled us to grant concessions and fixed service charges and do things like that. But this isn't ideal because it can cause confusion for traditional conveyancers if they're not familiar with the documents, and there will be transactions where a considerable amount of time needs to be spent explaining the nuances of what is not a traditional residential living model. I think also for us, probably the fact that it's not a traditional landlord-tenant relationship. In fact, our tenants don't like being called leaseholders. Our residents expect more from us than traditional landlord, and we cater to those additional expectations within reason, of course. And I think from the off, having independent living with domiciliary care, which is of course regulated by CQC, means that it's a unique relationship that doesn't match neatly with the Landlord and Tenant Acts. And then I suppose finally, in terms of challenges, it's the impact of those unintended consequences that Sally was talking about. We're seeing a lot of leasehold reform. Sally mentioned the right to manage, and in my first 6 months at Life Care, I found myself responding to a Law Commission consultation on right to manage, basically lobbying for retirement villages to be expressly excluded, which I know ARCO did too. And so reform is inevitable, which is not a bad thing, but the impact this could have on our sector when we're not always at the fore of decision makers thinking, it is challenging. And so that's why we need bodies like ARCO and others in the sector to kind of speak up as to how we might be impacted by that reform. So I suppose all of that kind of, combined together with our kind of history and connection with New Zealand has made us look at the possible benefits of an alternative form of tenure. And it's interesting listening to Richard, who I haven't met before actually, despite us both having worked at Life Care, and kind of understanding, I suppose, in more detail what's happening in New Zealand. And I think probably you'll see on the slide, I've kind of listed 4 benefits that I think are likely if there were an alternative form of tenure to develop in the UK. Arguably the UK is still in embryonic stages in this sector, and we're not as advanced as countries like Australia and New Zealand. So there's definitely an opportunity here to define a model that's tailored for operators and residents. But we need legislation for that. So we need all of the administrative, reporting, procedural requirements that protect both the resident and the operator. And you would hope that we would kind of end up with something that looks like a light touch regime as they have in New Zealand, which is pretty attractive. But we have to remember that the UK will have to legislate through primary legislation, and we wouldn't want that to become overly bureaucratic and cumbersome for operators to operate within. So, I mean, in essence, having a more easily understood legal framework will boost consumer confidence, and I think could also facilitate investment and development in the sector if we have something that is quite tailored. I also think that having a new form of tenure, from our point of view, offers more flexibility in terms of what our offering is to new residents. So as operators grow and change, we all learn from our experience. There'll be things that we want to do better. There'll be demand and expectations from residents that may change. And having a model which allows operators the flexibility on determining what to include as and when new tenants come into villages, it is really helpful in meeting consumer demands, but also our commercial needs, because we can reset those terms in a more easy way. I mean, I have kind of 2 others. I don't know if you wanted to come in, Michael, or should I just kind of go for gold and finish my 2 other points on the slide?
Go for gold, I'd say. Senator. Go for gold.
I mean, I can talk a lot. So I think also for us, the increased control over the resale process. So it's quite interesting listening to Richard talk about how that works in New Zealand. You know, we have seen probate delays. Last year, we saw quite significant probate delays because there were particular challenges with the offices. That's improved slightly, but there can be other reasons that there can be delays to resales. So we can have unmotivated or unwell vendors. You know, they may not be keen to sell or kind of feel there's a sense of urgency, or equally they may not actually be well enough to kind of deal with it because their needs have developed, they need to go into nursing care, and actually having an operator have control over that resale process is quite helpful because it helps them to kind of liquidate their asset if they do need to go into nursing care. Which is something that's worth considering because people assume that having a faster resale process is primarily beneficial to the operator, but actually it can be for the family members or the individual resident as well, who may want to kind of see that money come through more quickly. And obviously, from my point of view as a lawyer, the greater legal certainty with fewer grey areas, it is always a good thing. I think that it will improve consumer confidence. It will probably result in more investment in the sector, and it's a sector that is growing, and you know, there are more and more investors interested. So I think that would be key to the success of a sector that is, like I said, in early stages in the UK.
Thanks, Nana. Just following up from that, obviously one of the things we think about when we're thinking about a retirement villages act for the UK or something similar is the potential for growth in the sector, as you said. But for those existing operators who are already well established, how easy do you think it would be to transition over to a new tenure model if it was brought in?
I think actually much will depend on what it looks like and the level of guidance that we get from the government. There will inevitably be challenges and questions for existing schemes, and we have to look at the fact that we have a leasehold structure at the moment, and those individuals own their properties. So we're looking at things like perhaps surrendering leases and switching to an alternative tenure. So there'll need to be clear guidance, not just for operators, but also for the residents and tenants that own those properties, so they understand what is actually changing and how it benefits them. Because if there's no clear benefit, you know, why would they want to kind of engage? So I think that kind of guidance is key, and understanding what this model might look like and having early discussions. I know that kind of Michael does have kind of these types of conversations already. If we don't have early discussions with government departments to kind of explain how it could work, then we may end up with regulation that's really unhelpful in practice and actually doesn't put us in a better position. So I think guidance, good regulation, well thought out. We can't assume that we can just kind of take what's working in New Zealand and just put it into the UK. Unfortunately, the control find won't work, Michael. We need to make it work within our own system. So in answer to your question, I don't know that it would be easy for the existing schemes, but I think longer term it will be a really positive thing.
Worth it. Yeah. And finally, what do you think we would need to do in relation to consumers to educate the market about a new form of tenure? I mean, I think traditionally a license in the UK has been seen as the sort of lowest level of occupational rights. So, I mean, do you think consumers would be suspicious of a new type of tenure?
I mean, again, it depends how it's communicated and what type of information there is out there. I think that kind of bodies like ARCO, consumer protection bodies, you know, gov.uk guidance, there needs to be a kind of a layer of different type of information out there, because as a consumer you may be slightly skeptical to go from kind of ownership to occupation. It's a completely new type of arrangement. You're not going to be familiar with it. You may not feel as safe. If you're putting your life savings into something, you want to know that those are safeguarded. You know, you may have family members you want to leave money to. You don't want to kind of risk their future as well. So it's not just kind of educating the kind of the individuals that may be coming into the villages, but also their families, so they understand what that means for them, you know, when it comes to that individual kind of moving on.
Great. Yeah. And I think one of the things we've heard from Richard in New Zealand is that, you know, one of the benefits is that certainty. You know exactly how much you've got coming back at the end of your tenure. So I think we need to copy that in the UK, something similar. Right, so I think we've got a poll.
Should we? Yeah, we'll do a Q&A. But while we ask some of these questions, we have a poll here that you can fire away at. So we're going to put that up now for you to vote. But while that's ongoing, I'll try and we've got quite a few questions. I'll try and synthesize some of them. One of them is around the kind of the long-term security via the statutory supervisor. Because what would happen? So there's a question here. And there were others that were similar. One question was, what's the security for residents against the insolvency of the operator if they don't own the apartment? So what's the security there? And then there's the other one around if it becomes, if the fees, if it becomes unviable to actually provide all these services, because you might have overpromised, even with that statutory supervisor in place, what stops the village from suffering all the same problems of increased costs? So maybe, yeah, that question of insolvency and a bit more about what the what the statutory supervisor would do in those situations. Maybe for Richard, this one. Richard, you're still on mute. You might need to take something.
That has happened. So we've had operators go into receivership. The statutory supervisor with first security naturally controls the situation. And what's happened every time is that another operator comes along to buy the village because they don't have the same financial stretch. But it can't just be, it doesn't get broken up. I mean, there's an asset there. The model in New Zealand is attractive. Generally, operators fail because they've run it really badly. The residents are unhappy. No one wants to move into the village, or they've got financial stretch outside this asset. So they've got the absolute security of the statutory supervisor. Whereas if there wasn't a scheme supervisor in place, it would be every person for themselves. So there's absolute security there. If the operator hasn't got the P&L right, and so it's costing them more to run the village than they're receiving, then they've really got something wrong under our model. Appreciating the 30% deferred fee, let alone the capital gain, playing the long game, you're always going to be in surplus. And if you manage it well, you'll be in good surplus. So there's a lot of buffer, and that includes funding all the long-term maintenance as villages age. So you'd really have to be a poor operator to fail under our business model. If you get it all right, it's profitable when you've got happy residents.
And then we have a question here from Nick Sanderson, Richard. He says, your successor here. So he's saying hello via the chat here, I guess. How do banks as lenders to a village accept the trustee having a first charge?
Yeah, as I said before, it's absolutely no issue, because it's not like they've got 50% of loan to value ratio locked up in a fund in a mortgage already. It's simply first security, so it sits there at no value. It actually gives the bank far more security and comfort than if there wasn't a statutory supervisor there. So the whole asset is held together. Banks, as I said before, will happily lend on development of a new village, and certainly on the asset value of our operating village. So yeah, it's not unusual for them to lend up to 50% of the value of the asset.
Okay. And then another question here for both of you, and I think it's what percentage of the DMF would be put aside for long-term maintenance? And I guess that probably depends on the maturity of the village. But if we go to, I don't know, Sinena, and then maybe Richard after that.
I don't know that you would necessarily put a percentage away of it for it. I think if you have a proper planned preventative maintenance programme, you'll know how much you need to have ring fenced kind of each year. So I mean, kind of from my point of view, I don't know that we necessarily apportion a percentage of a DMF and say that that's maintenance, but you have to kind of keep live to what needs to be done to maintain the standard of your village, because obviously you have a vested interest in that staying to the highest standard in order to kind of resell at prices that kind of bring in more money.
Yeah. Richard, what's your take on that?
Yeah, so no statutory requirement to put anything aside for long-term maintenance, except that the statutory supervisor you are required to present to them your 5-year long-term maintenance plan every year. So you have to map out exactly what you're doing and what you're intending to spend. The villages we own are all around 30 years old, so you can imagine they take quite a bit of maintenance. The previous owner, for various reasons, had spent nothing on long-term maintenance for many years, so they're in a pretty bad shape. We are spending I couldn't give it to you as a percentage, but we're spending about 6 million Kiwi a year on long-term maintenance. We've built that up over the last 3 years. Prior to that, of course, there was a heck of a lot of reactive maintenance because things weren't being looked after, and new residents weren't so keen to move in because the villages didn't look 100%. So again, that's our investment in having a full village and selling at the best possible price. But again, if you look at the capital gain and 30% DMF, you've got a lot of cash flow to deal with long-term maintenance costs and the major capital costs and replacement costs that come up in a village. And again, that's peace of mind for the residents. They see what they get for their 30%.
I think it kind of reminds me of the refurbishment issue, and there's several questions here about how much you need to put in, but it reminds me of Cliff Cook, who's the owner of Lifecare Residences, when he said that this is effectively a fashion business, and in 30 years time fashions will have changed, and the purchaser then will need to, obviously you will need to make sure that you can provide what the fashion is at the time and not was the fashion in 2020. And I suppose there's an interesting relationship there. And I think one of the things that we've probably seen in the UK is that if anything, there's been under provision for capex. And I think one of the issues that we've probably seen is that, and this is really from feedback from people running retirement housing schemes or retirement villages. If you ask the residents themselves whether they would like to make these investments longer term, they're often actually quite keen not to spend money now, understandably, because they have fixed incomes and they might only think that they might live another 3 years or so. So I think there's definitely that shared interest. Okay, I think we're probably out of time for this session, but I'd like to say thank you very much to Sunena and to Richard. We're now going to share the poll results, and you can see, I think we can you all see these results? I'm hoping that we're sharing these now. And interestingly, 79% of you think that the new model of tenure would help the retirement sector grow, with undecided, but very few saying no. And I find this very interesting because my private prediction was that only 30% would say it would help, because I always get this impression that people are kind of quite hesitant for change. So I think this is very encouraging. I think that's definitely something we can build on for the future. So again, thank you very much, Richard. You could go to bed now. Like, I'm
Stay and watch the rest of the session.
Nice to meet you, Sunena.
Yeah.
Yeah. Thank you, Sunena.
Thanks, guys.
That's fantastic. Thank you.
Have a good day.
Guys,
We'll have a great day. And this is definitely work where we've actually done quite a bit of work also with Kyle from Trowers to think about, what are the legal changes that we would need to effect. The slight problem with this new model of tenure or the contractual model in the UK is that, as our speakers and as Sally has alluded, we'd need primary legislation for it. And we had initial discussions with the Ministry of Housing around what a leasehold reform agenda, or how this could be tacked onto the leasehold reform agenda. The problem with this, they're very clear that the next few years, unfortunately, is going to probably be legislation related to COVID-19 recovery. And that's why it's probably been pushed back a few years. So we thought maybe in kind of 2-3 years, we could get this on the statute book. That's probably a bit unrealistic, but certainly we're continuing that work to, work with members, with investors, with residents, which is really key, and with the wider advisory community to make that work. So that was great. And I think we're now going to bring on our panel of lawyers, and there's a value in there too. And I'll hand over to Sally for this one. And this is really something about, if we're looking at event fees, obviously a big issue in the sector, the DMF that Richard has mentioned, the direction of travel is very much going in this towards that model, but people actually getting value for money or perceived value for money for those event fees, and there's no right or wrong in terms of the level of that. However, there are still some legal uncertainties because we are operating within that kind of very vague leasehold system. So we're really pleased that we had Pinson Masons, CMS, Trowers and Hamlins, Gowling, and Eversheds really come together and work with Sally on what we think is a definitive guide to this area. And I'll hand over to Sally to discuss that a bit more.
Thanks, Michael. So yes, this part of the event is launching our event fees guide, which we've prepared in conjunction with our 5 law firm partners, so who are represented here today. I'm very pleased to have them all with us. And it's called Event Fees and Housing with Care, What Now? And I think we have a slide just showing a screenshot of the cover of that. And then after the event, you will all get an email which will give you a link to a digital copy of this guide. Now, in the absence, as Michael said, of primary legislation, so we and the sector are thinking, you know, what can we do for now before we get our own retirement villages sector-specific legislation? And event fees or deferred fees are a really important part of that picture. They've been around for a while. They've been talked about, and there's been a big program of work at the Law Commission, of course, looking at them. But there's actually not been much movement in the last couple of years. So the Law Commission produced its report on event fees in retirement housing in 2017. The government welcomed its proposals, but we haven't really seen any movement since. Just to start with, what is an event fee? I'm sure everybody knows, but just to remind everyone, it's a fee which is payable under a residential lease of a retirement property, triggered by certain events, typically resale or assignment of the lease, but also it could be subletting. And it's sometimes referred to as an exit fee or transfer fee. We've also heard DMF, deferred management fee, talked about earlier today. Now, in the past, event fees have been controversial, but in our view, in the retirement community sector, the use of these fees can benefit both the operator and the consumer buying a housing with care property. They make housing with care development sustainable for operators, and they also mean that both the resident and the operator have a mutual interest in keeping the long-term sales values in the properties high. I think Sunena touched on that in our earlier discussion, and therefore in keeping standards high in the community. And they allow other costs to be fixed and to remain affordable for consumers to enter the scheme and to be sure that they can afford the regular charges there. So this cost certainty, as we know, has been highly sought after by customers who are likely to have a limited income in older age. And so we've produced this guide in order for operators, including our own members, but also people thinking of entering the sector, as well as investors and funders, conveyancers and policymakers, to consider how event fees could and should be used, and whether any further regulation in line with the Law Commission's proposals would be beneficial. And what the Law Commission has said was, you know, event fees are perfectly legitimate, and, you know, they can be a very useful tool for both operators and consumers, but they have to be fair and they have to be transparent and they have to comply with consumer law. And what they've proposed is an approved code of practice, which would be approved by the Secretary of State to give more legal certainty to consumers, and also some additions to the Consumer Rights Act, by which you know, a term in a lease which didn't comply with that approved code of practice would be likely to be thought of as an unfair contract term and therefore unenforceable. So this would improve legal certainty further. But here to discuss the situation are the experts. So firstly, just to turn to Dominic Morris, first of all, from Gowling. Dominic, can you talk about how the use of and the interest in event fees has increased from your perspective over the past few years?
Yeah, thanks, Sally, and good morning, everyone. I think this is really sort of symptomatic of where we see the sort of housing with care sector generally. The market is maturing considerably and has done over the last few years, galvanised, I think, by the Law Commission report on event fees. And I think it's well rehearsed, I guess, the attraction of the sector to investors coming in, the ageing demographic, the undersupply of specialist housing for under people. And I think increasingly for real estate investors, the attraction of operational real estate, which obviously this sector sort of sits squarely in. So over the last few years, I think it's been sort of game changing for housing with care that we've seen big institutions, investors coming into the market, so L&G, AXA, Goldman Sachs. And what they've done, I think, is they've rapidly sort of ramped up visibility for the sector and also credibility for the sector. And they're all participating in models which are using event fees, and all of that helps to sort of galvanize and gives confidence to people around that. I think it's sort of worth sort of drilling into how event fees sit as part of the operating model for housing with care. And typically it sort of falls into two parts, where if we're talking about the long lease model as opposed to rental. So typically there's sort of a development opportunity, selling these apartments on long leases. And then more importantly for operators and most of the investors, it's the operational play, and key to that are event fees. It's generating stable platforms of long income for the operators. So I think, again, we're seeing significantly increased uptake over the last few years. I think it's not only the new institutional investors, I think new entrants into the sectors are sort of automatically almost adopting the event fee model as core to what they're looking to do. And we're also seeing people in the retirement living sector sort of more generally, I think, looking at the event fee model and how they could apply that sort of operational aspect to what they're doing. But sort of just to round up on the point, I suppose it is still a maturing market. It is still a small market. And there are those investors that don't yet sort of think there is a body of evidence around event fees that they're happy to sort of invest off the back of them. And so for those investors, and I think probably for most funders in the market these days, the development opportunity is still core for them. And I think Peter Youngs will probably come on to talk a bit more about that.
Yeah, we'll look forward to hearing from Peter later on about that. Thanks very much, Dominic. Turning to Candice now from CMS, what are the main questions investors ask you about event fees?
Morning, Sally. I think the sort of things we've been discussing earlier. So firstly, what are they? Which you've explained beautifully. Secondly, the terminology, I think, is very confusing and tied into the different lease structures. And as you've said, development management fees, contingency fees, exit fees, transfer fees, deferred payment arrangements. I mean, I think it's urgent for the industry to agree what this is going to be called and when it's going to be applied. And I think investors in retirement living are often modelling long-term payment structures. So they want to know what the charges will be. And that can be anything from 1%. I've never heard it as high as 30%, certainly, but I've certainly seen it at 20%. And that is difficult to do comparative modelling across the country and across different schemes. And I think finally the rules, because as we're discussing this morning, 2017 Law Commission report, then a recommendation 2019 from the Ministry of Housing and Local Government, and still know nothing other than what ARCO have produced, working with, I know, a lot of the operators, but I think some sort of statutory code is long overdue.
Yeah, absolutely. Turning next to Philip Tanney from Eversheds. What impact did that Law Commission report in 2017 have? Obviously, we all know it very well, but more generally for the sector.
Sally, yeah. So I don't think we should forget that event fees are something which have been around for quite a number of years. And the discussions around event fees are something which have been investigated in the past. So in 2013, we had the Office of Fair Trading investigate the use of transfer fees, which they found were potentially unfair terms under the what's now the Consumer Rights Act. And I think that created a fair degree of uncertainty in the market. So when the Department for Communities and Local Government commissioned the Law Commission to consider the question of the broader question of event fees in retirement living sector, I think that was an important step along the road of making sure that everybody recognizing that event fees were something which were reasonable, both from the perspective of people buying apartments in retirement villages, and also for investors, developers, funders, and operators. So when the Law Commission finally delivered their report in 2017, they'd undertaken a very thorough look at the sector And it was really pleasing to see that they decided that event fees were reasonable, they were lawful, and that they were legitimate. And I think that that has given the whole industry and also consumers a real confidence boost that this is something which is investable, both from a consumer perspective and also from the investors and funders and the operators' point of view.
Absolutely. Turning to Kyle and thinking through those Law Commission recommendations, I mean, how helpful do you think implementation of those would be to growing the sector?
Yeah, hi, Sally, and hello to everyone. It's an interesting question, and I think the base answer is absolutely it would help. But I think if you go back and look at the Law Commission's recommendations, there were 23 of them. But if to drill down into that, really, I think the two key proposals were a new code of practice that would provide some context and some rules about when event fees could be charged. And then also imposing some standardized disclosure requirements across the sector, you know, on operators and estate agents, to provide clarity to the customer and indeed to the operators about, you know, what good looks like from a disclosure point of view. And then the second part really was bolting that code of practice onto existing consumer rights law, which, you know, we've got to remember is what applies now. You know, there is law that applies to event fees. So bolting that onto existing law to make it clearer again for the benefit of customers and operators and indeed those investing in the sector, you know, what compliance looks like and a consequence, a clearer consequence of not complying, which is that you're probably not going to be able to charge your event fee. So I think in principle, those are good ideas. We supported them. Most people, I think, would say that that I talk to would say that they agree. That in principle, those are good things because it's giving sector-specific context for the benefit of customers, operators, and investors, as I said, and adding some clarity. But I think having said that, as a sector, we've always got to be careful to ensure that we're balancing things. So we want new regulation to give customers certainty because that's key. But we want to also make sure we do it in a way that doesn't inadvertently stifle the growth of the sector.
Yeah.
And I think actually when you start to drill into some of the detail, there will be further conversations to be had to make sure that we achieve that goal. A couple of things that were mentioned in the government's response to the consultation, which as Candice mentioned was March last year. You know, there was one point around how the online database that's going to form or proposed to form part of the disclosure and resale process will work, which government wants to look at a bit further. And another really important one is succession rights, which I think is really important to resolve. You know, just so that when a customer does the normal things that we humans do, and, you know, older people are just like us, as we talk about a lot in the sector, you know, they get married, they start sharing occupation with other people, and understanding what those kind of steps mean in the context of event fee triggers, and the customer and the operator both understanding, you know, what the deal is and how that deal is actually going to play out over time. And I think a final, more general issue is just making sure we link compliance and consequence, so we don't have a hairline trigger that somebody misses a date. So instead of disclosing within 2 days, we take 3, and suddenly that means we can't charge an event fee. You know, even though we've done everything properly, the customer completely understood the deal and was happy, and so on. So yeah, broadly, absolutely right that we take forward these proposals, but I think some further discussion really important to make sure we strike that balance between customer certainty and growth of the sector.
Absolutely. And just turning to James Long, hopefully we'll keep him on the line, so I think he's having a couple of technical problems. James, can you hear us? Is he on mute? James, can you hear me now? Okay. Well, maybe we'll give James a bit more time to join in. In the meantime, Michael, I'll turn back to Michael to bring in Peter Youngs from Knight Frank.
Yeah, I think I was just going to follow up on Candice's point about the terminology, which I think I absolutely agree with. And there's too many different terms that are being used to describe what is actually a similar thing, which is a charge triggered at the end. I think deferred fees or deferred something fees is probably the easier one. The good news is that all of our members are in agreement that we need to find easier language. So that's great. The bad news is that they all suggest their particular term as the one to be adopted. So still some work to do in terms of making sure that we end up with just one term. Bringing in kind of Peter Young's, because I think obviously the issue around event fees is it contributes to the long-term sustainability of running a retirement community business with housing care and other services. And we've heard about people making comments about the operational real estate. And then obviously the question comes in, how do you value these long-term income flows? And obviously there's questions about how you then bring those into development appraisals and other issues. So I'm pleased that we have Peter Youngs, who is a partner at Knight Frank and looks at valuation of these income streams probably on a daily basis, I guess, Peter. So like, kind of you're a good person to ask about this. And just how has your clients' approach to event fees changed over the last few years?
Okay, good morning, everyone. It's interesting. The market is evolving. Institutional investment into the sector is really important, and this has been happening in recent years. And they are investing in senior living or housing with care with an event fee, which is driving the market. Now we're in a development phase for senior living, say compared to more established real estate in the UK. But what we want to do is build retirement communities which provide attractive housing options for seniors, but as we were already saying this morning, also provide stable operational real estate assets. I mean, event fees have an important part to play in this question and working out the best proposition for residents and to support investment. The regulation and legal framework, as discussed, certainly provides certainty and clarity and is supportive. What we're seeing with the operators is that they're now offering different financing options to the residents. We're seeing a wider range of event fee structures, for example. And in some cases, higher event fees have been offered in return for lower fixed service charges, which surely must make a lot of sense to people that are relying on pensions and savings. And I think what this is about is just offering people choice.
And in terms of the, what are the main drivers when it comes to valuing deferred fee income? Just briefly, without going into the whole technical details, but what are the things that are important in that context?
Well, when we look at it, first we look at the proposition, and we're looking at the sales room, what works for the residents. As I hope you all know, retirement senior living is there are developments that include significant amounts of communal areas, lounges, guest suites, restaurants, gyms, and so on, which are all, and as well as providing a range of services for residents. And the key part of the appeal is the community that's generated in these spaces, which also have to be paid to be built. The event fees support this, and it also creates an alignment of interest between the operator and the residents. The event fee is a gross income, and there are costs associated with achieving it, and it also takes a number of years for the income to stabilise. It requires specialist advice, and we at Knight Frank, we've been collecting data on absorption, in other words, how quickly the units sell in the first instance, how long residents live in the retirement communities, and also how prices move over time. And along with the aggregate development value, this is modelled in a discounted cash flow to net back to the position which is discounted back to the present day. In practice, what we need though is more transactional evidence, and I'm sure this will come in time. And stabilised or mature retirement communities, the event fee is just one component of the operational real estate asset.
You mentioned that the net to gross, because obviously what we've heard from Sunena and Richard earlier is that obviously the investor has to, kind of put quite a lot of money into the long-term maintenance. What benchmark do you use to work out, well, we know how much money will be generated by the event fees, but how much of that will then be plowed back into a scheme versus how much of that might be available as a deferred profit element if, for example, the developer made or the operator made a very marginal development profit up front?
I mean, that's a tricky question to answer. I don't think there's just a one number that fits, but I think that what I'm happy if we talk in terms of a stabilised asset, What I'm looking at is the account management information or profit and loss, and I'm looking across the revenue streams, and I'm looking across the costs that are being incurred. I'm scrutinizing those inputs and seeing whether I think they that make sense and whether they look stable. And I'm also looking, for life cycle costs, reserves, and clearly that money's being reinvested back. As I think others have already covered this morning, that's really, really important. And unlike, say, for example, general housing, when you do go round older retirement communities, the well-run ones, you'll see the communals can still be really in first-class condition. And there's been significant investment to sort of maintain quality of the asset.
Mm. And seeing that we're talking about regulation and what colleagues have said about, additional regulation would be good and drive the market further. How would that change the valuation if we had, I'm not just going to say more regulation, but better regulation?
Yeah, no, absolutely. That was one of the things I was going to say. It's got to be good quality regulation. There's got to be buy-in. There's got to be clarity. People got to understand. It's got to be accepted. But that being the case, to be frank, I believe that the discount rates will come down over time. But the difficulty is assessing what time scale that will be over and the levels to which it will move. But yes, well-drafted regulation increases certainty and transactions, and this will help because the evidence it creates supports valuations and informs valuations. A great deal will depend on the rate which the market grows and the volume of those transactions. We're presently undersupplied with suitable housing options for seniors. There's an aging demographic which we're all aware of, and we need to address the challenges in the social care system in this country. So I think there's a great case for investment, but it's the transactions, the evidence that are important.
Mm-hmm. I think that's a sign, I guess, of the market which is still developing. I suppose like we had our AGM last year, we concluded that this might have been the end of the beginning of the sector here in the UK, and actually we're now into a different phase. So it's interesting to hear that from you too. And then just a final question, really, what would be needed for banks or lenders to fully take account of event fees? What would they be looking for?
Yeah, we and others are working hard on increasing the lenders' understanding of the sector and the lending criteria for seniors housing and the appetite to take on operational risk beyond the development phase. There's presently a focus on sale prices, but this overlooks the fundamental parts of the proposition. Development finance, what we're seeing is lending over the development phase. The operations, though, take time, a number of years to stabilise. That's a number of years after the apartments have first sold. So for valuations, you need to have a grasp of the detail, and the residual valuations have lots of inputs and moving parts. More land deals from event fee operators will be extremely helpful. And I suggest those sorts of questions are going to become easier once we've got more stabilised or mature retirement communities.
Okay. So I think lots of work to do, and I think that's something certainly where we're interested with working with the wider valuation community in really looking at what could more standardized methodologies look like, and what could you tell us in terms of to take back to our partners in government to make sure that works. So, but it's encouraging to hear that the direction of travel seems to be going in that direction. I think we're now going to do QA. There is, do drop your questions into the QA. Sally's now going to ask our panel some questions. You may have seen that James Long has kind of popped in and out, and unfortunately we can't. We'll see whether we can bring him on.
Yeah.
Yeah,
he's having a technical problem, or maybe he's worried I was going to ask him about Scottish law, which I was going to. But we're going to we'll get his contribution in the write-up that will come after the event. So I think we'll just move on to general Q&A now. He's having some issues with his connection. So yeah, I mean, really for the legal panel, looking back at the first part of this event, just really wanted to hear your views on what difference you think a new model of tenure would make in the UK to the sector and to your clients, and how we could best promote that really, and overcome any kind of suspicions about licenses or wanting to sort of own bricks and mortar for consumers. I mean, Dominic, can we come in first on that?
Yeah, thank you. I'd say I'm wholly supportive of the move, but I think we have to be sort of very mindful of the nature of the legal market in real estate, and indeed investor sentiment, funders, etc. we are all fairly conservative, as has been seen by the adoption of common hold, as you came back to. It's been a failure, basically. So it's all very well legislating, but if there's not going to be take up, then there's little point in doing it. And I think you also, as you say, there are already a considerable number of people living in leasehold structures, which are working well, and that's the model that's continuing to be rolled out. So we just need to be very mindful of, which has been touched upon, the sort of transition arrangements and how the two can dovetail together without sort of impacting what everyone's doing at the moment, because I think it is going to take some time to get to where ultimately we want to be.
Yeah. And Candice, I mean, in the meantime, in the absence of that that retirement communities legislation, what more do you think we can do apart from what we're doing to make the case about event fees at the moment? Is there anything else that the sector can be doing to increase legal certainty and promote high compliance?
Yes, I mean, I think things like this and the consultations Michael and you have already been involved with through the British Property Federation, who are also actively lobbying and looking at this industry, are essential. Education for consumers. I think press, it would be good to get the press on side, because I've lost count of the number of negative press stories.
We've had some really good ones recently, actually. Oh, Michael.
Yeah.
Yeah.
So I think, yeah, discussions like this are very important. Carry on. And picking up also on what James was undoubtedly going to say in relation to Scotland and what Dominic just said on common hold, although common hold's not been successful so far in England and Wales, it has operated very well in Scotland for years. So I think that is worth more discussion.
Absolutely. Philip, we've had a question about service charges and deferred management fees and how they're different. So maybe can you talk a bit about when you're structuring a lease? Is he still here? Yeah, you've moved across. Sorry. When you're structuring a lease, you know, how do you look at that balance between the sort of regular charges and the event fee, and how to make the best arrangements for the consumer and the operator?
I think very much that you have to take into account what the consumers want, because let's not forget that most of the people in the retirement communities are going to be on relatively fixed incomes, and what they do not want is wild swings in service charge from year to year, which gives unpredictability and uncertainty for them. And particularly in that age category, that's something which is a real concern. And I think that there is a balance to be struck, but one which, in my personal experience, is one which people actually, when you talk to them about it, would rather have the fees at the end rather than the ongoing basis.
Absolutely. Now, we seem to have got James back. Let's just check. Give him one more go. James, can you hear us now? No. Oh, it's a shame. Anyway, we'll get him in the write-up. But turning to Kyle, obviously we heard from Richard Davis earlier. I mean, how well do you think the New Zealand model would work in the UK, and do you think it would need a lot of adjustment and change to fit in with our system?
So I think the principles behind that system would work here. You know, I frequently say that if you look at the New Zealand demographics across age and across home ownership, which Richard touched on earlier, you know, apart from the fact that we've got a little bit more space per person than we have sitting on this island right now, you know, there's a lot of similarity. I think the point to take away though about that system is it's statutorily backed, as we've touched on, and actually the way that system evolved in New Zealand was, you know, people were trying to do things to get away from existing structures that were challenging. They could be made to work that were challenging, which we have here with leasehold. And then there was some timely regulatory intervention driven by the sector, not imposed on the sector, which is pretty key if you want to make sure you strike that balance I was talking about earlier between customers and operators. And then over time, you know, not everyone just didn't switch to start doing occupational rights agreements straight away. It was gradually phased in over time as the market saw that it was workable, that it could be trusted, and that the regulation that underpinned it, you know, was suitable and struck that balance. And there's some pretty critical parts of that, you know, the statutory supervisor role, which is, you know, as Richard said, it's basically a duty of care owed by an equivalent to an FCA regulated trustee, you know, benefiting the customers in a particular village. You know, that would take some time to get to a point where we could introduce those kind of in the UK. It's not beyond possibility, and that's exactly the system that we would look to adopt. I think it's crucial that there is that kind of real in the entry regime to give that stability. I think also in the meantime, we've got to look at, you know, as Michael said, it's going to take 2 years to get to the point where we can have meaningful conversations about that, because of the coronavirus pandemic is clearly going to have an impact. Brexit is starting to come back to the discussions, also will have an impact at the time, and availability of government. You know, what we do in the meantime, what are the short-term solutions? How can we make it easier, for example, for operators to treat leases, which is what we want to sell here, closer to an occupational rights agreement or a life interest, which is, you know, ultimately I think what the sectors a lot of the time try to do is sell 150 or a 250 year lease when they're really trying to sell life to a customer, you know, and try and make those things be a little bit more alive if we can. And there are some things that I know we're doing and that could be to achieve goals.
Yeah, absolutely. And I think the key points I'm taking away from today's discussion are around that, you know, the standardization of terminology, which we've already been thinking about at ARCO, and that clarity and certainty for consumers and operators, which is obviously what we see with the kind of standardized documents and disclosures in the New Zealand system. And I think, you know, it shows us the right way to go in the UK, but obviously a lot of innovation already happening with operators to take us closer to that model.
Great. I think that kind of brings us to the end of our session. So we said we'd take about an hour and a half. I'd like to say thank you to all of our panelists today, and particularly Trowes and Hamlins, Gowling, Pins and Masons, CMS, Eversheds and Knight Frank, because what we were really lacking before was, you know, we had lots of people asking us what's the status of event fees, and we couldn't really point them anywhere that was an authoritative source. And I think now we have that with the help of our esteemed legal colleagues here, and we'll certainly make sure that is seen as the kind of the gold standard interpretation of what investors and operators should be relying on. I think there is quite a lot of work left to do, as we've seen. I would also like to just plug our next event, which is coming up on the 30th of June. That is going to include, that's about planning and the planning system for the housing with care sector. It is written in conjunction with the County Councils Network and will be chaired by Phil Collins, but that's the Times columnist, not the drummer. So just to be clear on that one. So we're very much looking forward to that one. But yeah, I think what you've probably have heard is that the search for a tenure model which is more specific and actually can take care of both operators and consumers' needs is something that, interestingly, you know, there seems to be quite a large agreement in the sector that is what we need to work towards, and we've certainly got our work cut out. Some of you might have seen that we've published a growth action plan, and we're discussing that with the government, and there's an early day motion in Parliament as well calling for the growth of the housing with care sector that we worked with some MPs to table. So plenty going on, but plenty of work still left to do. But again, thank you very much to our speakers, to Sally, and also to Ellie and Katie, who've been making all the kind of the technical wizardry work here in the background. So thanks again for tuning in, and we hope you enjoyed the session, and we hope to see you on the 30th of June. Thank you very much.